Well, hello everybody, and welcome to this episode of Savvy Investors right here at VectorVest. I am going to be taking you through one of my favorite conversations today, and that is my top 5 investing reads. I love to read and I love to write. So one of the books that I'm going to be featuring today is actually one of my own, and also I have a range of others that are some you're going to expect and some I don't think you will. So I'm going to bring you right across the spectrum today so that you have 5 great reads from an investing point of view. Now, before I get started, I would first of all like to welcome everybody who is joining me here today. It is always super to have you, and today is a little bit different because where I am joining you from is the Ohio office of VectorVest. I am right over here and I am based in America today and I'm loving it. I have been really grateful to spend the past couple of days here with the VectorVest team in Ohio, and they are giving me a super welcome. So today certainly feels very different from my point of view. But let me just give you a little bit of background on this show. And while I'm doing this, please do, as John has started, please do tell us where you are joining us from. As you know, I really love to hear where people are tuning in from. Savvy Investors at VectorVest is designed to be a show that gives you the accessibility towards the stock market. It's designed to give you real-time insights into what's going on, whether it is how is the economy feeding into the stock market, like today when we're going to look at ways in which you can build your own investing acumen, and of course also I usually won't today, but I usually love to talk to you about earnings calls as well. And that is what Savvy Investors is all about, is building your own toolkit to be able to navigate the twists and turns, the adventure of the stock market along the way, supported by VectorVest right here. As I say, now that I'm here in Ohio, it's all the better. So I'm just going to pop on over here, take a look and see where people are joining us from. Okay, John is joining us from Boston. Hello, John, you're very welcome. John says it's very humid here. It's beautiful here in Ohio at the moment. Joe is joining us from New York City. Manju is joining us from India. Hello, Manju. Aviad is joining us from Israel. Tom is joining us from Burlington, Ontario. Hello, Tom, you are very welcome. Kirk is joining us from Beloit in Wisconsin. And let me see, Aviad says, can we check on upper stock? If we can, certainly we will do our best. Amir says you're joining us from LA. Kent is joining us from South Carolina. Sharon is joining us north of Seattle. And in Washington, Roger is joining us from Toronto. Dave is from St. Louis. Amir says good morning. Jose has I think he's waving money at us in an emoji. Raj says is joining us from San Francisco. Yi joining us from Belgium. Ash is joining us from Calgary. And Amir says he also wants to know about VRTX and Nvidia, Tesla. Robert joining us from Cincinnati, also here in Ohio. Been there, lovely city. Love your chili. Aral is joining us from Mississauga. Rose is joining us from Victoria. Carrie is joining us from Texas. Cal is joining us from New York. Brilliant. Keep them coming. Keep them absolutely coming. As I say, I really do love to know where you're joining me from. Now, I'm going to take you through 5 of my top investing reads, and there's many more, and I certainly will feature future video or future books in future streams, right? I will do that, but I'm going to start off here with the first one because I have loads and loads to talk about today. I'm going to start off here with the first one, and can I first of all ask, when I bring up each book, will you tell me if you have come across it before, right? So this is the first one, The Psychology of Money, Morgan Housel. Have you come across The Psychology of Money? Let me know there in the chat. How many of you have seen it? How many of you have read it? How many of you have seen it and said, yeah, I should look at it, etc.? How many of you have read it and you practice several things out of it? I'd love to hear your thoughts on this, right? So Psychology of Money, that is my first one up today. Maria is joining us from New York City, and Mura is joining us from Florida. Roger has not heard of The Psychology of Money. Sharon says no as well. Okay, I'm delighted that I'm bringing a new one to you. So this one, as you can see, is Morgan Housel, and it is called The Psychology of Money. First of all, it is about finance broadly, but there is a lot of investing insight in here. It's a very easy read. It's written very simply. I reread it on my flight over here from Dublin to Cleveland last Sunday, and now I didn't finish it in that period of time, but I have certainly read this in 2 sittings. The only reason that I would stop and put it down is it makes you think a lot. In my opinion, it makes you think a lot, right? So this is, Kirk says right next to me now, need to read it. I agree, Kirk. Maria said no, Terry said no. Deb is joining us from Reno, Nevada. You are very welcome. And Maria is joining us from Maine. Delighted to have you. Okay, so the psychology of money is, as the name suggests, it's all around the psychology that we have with money. And it talks and differentiates a lot about what it's like to do things in theory and how we actually act in person. So I'm going to take you through 2, 4, 6, 7 points out of this book, right? And we're going to start off there. The first thing in the very first chapter he talks about here, he says that no one is crazy, right? That's the first chapter. So what he does is that he talks about the fact that a lot of us are shaped by the financial environment that we are born into and that we mature into. Let me characterize the economy and the stock market right now. So I would characterize it as a place where if you were investing at the moment, you would say the stock market simply does not react to bad news. It has taken a huge amount of inflation. The ECB has just announced that it has its 9th increase in interest rates. The Fed increased interest rates as well yesterday. We're looking at what's going on with the Bank of England, and they are increasing rates even higher again to some eye-watering figures. We are seeing constant threats of a mild recession, particularly in the US. We are seeing, broadly speaking, anemic growth, I would say, in Europe. We saw a big decline in tech stocks last year, and then we've seen a really strong revision of that. We saw an awful lot of tech layoffs last year as well, and that has been, broadly speaking, absorbed by the labour markets across the world. So if you were investing right now, you would say, the stock market doesn't really seem to react very much to bad news. If we were to go back then and let's take a look at the stock market between 2000 and 2010, you would have said the stock market's a disaster. It was a lost decade. A dollar invested in 2000 pretty much was still a dollar invested by 2010. And of course, you also had a really big shock that happened in 2008 and 2007, 2008, and then turned around about February, March, April, depending on what part of the world, in 2009. If you go back to the 80s, you would have said really high interest rates. House prices were driven and dominated by very high interest rates. Massive amount of disposable income was absorbed by extremely high interest rates. If you go back to the 70s before that, you would also say, of course, characterized by a lot of inflation. If you were to invest from 2010 until 2020, January 2020, you would have said the stock market is wonderful because there was a huge amount of quantitative easing that happened along the way. And all of these, like I'm characterizing them now very objectively, but all of these, of course, invoke emotion, hope, fear, ambiguity, uncertainty, an automatic assumption that the average return will hold, an automatic assumption that central banks will always print their way into putting more money into the stock market. We make assumptions about this, and that's one of the things that he starts off by talking about, is that our psychology of money, the way in which we think about things, like the things I've spoken about, returns, inflation, asset classes in the first place, they are often shaped by the environment that we're in, and the environment that we're in can be very different according to different times. So we assume a status quo that can be very different to a generation behind us. Then, of course, another thing that he talks about in here is the power of compounding. Now, I'm sure lots and lots of you know about the power of compounding already, and you say, yeah, look, compounding is great. But he does talk about a very striking statistic, and I want to mention this to you. And this is on page 45 over here. Yep. And that is this, you can see here, this statistic, that's right here. And that is that 81.5 billion of Warren Buffett's 84.5 billion net worth came after his 65th birthday. Our minds are not built to handle such absurdities. So what he does is that he critiques the idea that Warren Buffett is a super investor from the point of view of the individual returns that he makes on an annual basis, and instead points to the fact that Warren Buffett is investing since he was a teenager, and it's the power of compounding is really what drives an awful lot of our returns. Now, let's think about that, right? When does compounding happen? It happens over time. When do we make decisions to invest? At the beginning of that. So if I am starting off investing today, and let me just ask you right here now, can I just ask you, how long are you investing? And some of you might say you haven't started yet, but how long are you investing? How many years are you investing? I started investing, by the way, in 2007. That's when I started investing. Had a disastrous 2008. And of course, from there, did get back in the market in 2009, and delightfully so. And I'll take it from there. Okay, so I'm just going to take a look over here. See who have I not spoken to yet? Mal is joining us from the UK. Mike is joining us. Bloomington in Indiana here. John says, how are we up in Maine? Okay, John and Marie are having the chats about the weather. Francisco is joining us from Chicago. Leon is joining us from Texas. And let me see here. Aviad said it is investing with 3 years. Mal said compounding. Very important to get your broker fees right here. Yes, very good point, Mal. We'll pick up on that as well. Dave says 46 years. Iraj says 35 years. Maria says since 2020. Terry says 44 years. Roger says 1998. Interesting time. Mal says 2003. Another one. Interesting time indeed. Both of you, you got right the other side of things. Greg is joining us from Cleveland, Ohio. Only down the road from you here, Greg. Tom said bought his first stock in 1965. Chris said 3 years. Thought it was a superstar late 2020. Learned that was not true in 2022. We all go through that, Chris. So the point I'm making is that the time at which the idea of compounding you're learning about it is the very time at which you can't get at it, because it takes time. And I certainly I remember, like, when I started investing first, looking at my trading account all the time and saying, oh, I'm up at 1% and down 2% and all that sort of thing. Compounding doesn't happen in that period of time at all, but it certainly does change over time, and one needs to have the patience to do that. But the only thing that can drive you to have the patience to do that is to have the belief that it will work out. And that is why you need to go back. And that's why we have back tests. And that's why we have data that goes back. And that's why we have things like auto timer in VectorVest, so that you can go back and you can see the impact of your results. And I do certainly want to make a point, though, that we often miss. And one of the books I'm going to talk about today as well is focusing on dividends. But I want to talk to you about the power of compounding that very few people ever talk about. So let me just show you that one, right? So what I'm going to do is pop on over here, and I'm going to bring up to you, I'm going to bring up this this dividend history, right? The reason that I bring up Colgate's dividend history is that it's paid out dividends since 1895. It's a really good dividend paying stock. Dividend yield at the moment is 2.46%. Now, I could sit here and I could talk to you about the dividend yield, and I would on another day. I would. I'm a dividend investor myself. But the thing is that dividend yield is only 2.46% if I buy stocks today. Now, think about this. Think about the power of compounding from a different perspective. Let's just say here is I'm going to pull up a stock graph here, and I'm going to put in Colgate. Let's say that I buy Colgate for its dividend because I'm a dividend investor, and I'm going to go back. Let me go back 10 years, right? So 10 years ago, right, I bought and sold Colgate several times, particularly through an option. But I'm going to take this price back here. This price back here is $60. So back then here, I bought Colgate stock, $60 back in 2013. Okay, and as you can see, since then it's gone up, it's gone down. It reached a high up there of 86.41. It's now down to 71. But let's say 10 years ago, I bought the stock at $60. Today, the annual dividend is $1.92, right? So I'm just going to get a calculator here. 1.92 divided by $60. Multiply that by. That dividend yield is actually 3.2%. But you're not going to see that up here on Yahoo Finance. And how could you possibly? Because that is dependent on you buying the stock at a different period of time. The point I'm making here is that the power of compounding doesn't just happen on your realized returns. It also happens in terms of your dividend yield. So if you have a stock that is producing a higher dividend, which, by the way, Colgate is one of them. Let me just run back through. Look over here. You can see that in general, let me just zoom in here, right? You can see here, Colgate increases its dividend. Kind of always does. So the thing is that if you buy a stock and the dividend increases, well, then of course that also is another element of compounding that is very hard to calculate. I can't show you that on VectorVest either. I can show you the dividend on VectorVest, but what goes underneath the line, the dividend yield, is always back to the stock that you actually buy. So one of the stocks that I held for the longest ever was CRH. CRH is an Irish company. It's the largest Irish company it's the largest listed Irish company. And I was getting beautiful dividends from that stock as time had gone on over time. But the dividend yield that was on VectorVest, or that was on the NASDAQ, or even that was on its own website, was inaccurate because it was relative to the price at which I bought. And that's another point that I wanted to bring up about the power of compounding, is that your dividends, of course, compound as well. If they're higher, your dividend yield is higher. So if I bought Colgate 10 years ago, my dividend yield would be at 3.2% as distinct to 2.46%. And that's something to bear in mind as well. Now, let me now move on to the next point that I wanted to bring up in this, and that is tails you win. Okay, this is the chapter here down here. Okay, so this chapter here is called Tails You Win. If you look, just take a look at how long each of the chapters are. They're about 10 pages long. That's what I mean. It's a very simple read. Tails You Win. The point it makes here is that a lot of the really big things that happen in life, really big things, often happen rarely. But if I was to think about like some of the biggest things that have happened in my life, let's say from an investing or a professional point of view, I only need a small number of those to happen to have a really big impact. And I remember having a conversation with Dr. DeLito in his office right up here at the other side of this hall. And I remember him telling me about what it was like to invest in February, March, April 2009. I distinctly remember he said, you only need a couple of these types of events, Susan, to make your fortune for life. He said, the mistake I made is that I didn't go in deep enough at the time. And I was thinking about that, and that's very much one of the points that comes up in this book, is that you only need some small things to happen that have the biggest, that can have a really, really, really big impact. So we might think we need to have a lot of really good trades, for example, to happen in order to deliver outsized returns. And can I just ask you, right? I'm just going to ask you here again. Can you tell me some of the biggest things that have happened in your business or investing or career or professional life? What were the biggest things that happened? And secondly, I'm going to ask you what was the trigger for them. And when you're telling me there in the chat, I'm going to tell you one of these along the way. In 2011, I went to the Traders Expo in New York. Myself and my husband went to the Traders Expo in New York. At that time, we attended a day-long seminar about managing options. Now, at the time, I had done my dissertation in options. I had been investing in options for a couple of years at that stage. And so my husband and I, we went to this day-long seminar. And that day, we met a company that led to have a really big impact on my investing and on my career and on my business and professional opportunity set. That was the day that I met VectorVest. Little did I know that I would be sitting here in July 2023 live with this webcast or with this live stream here with you, where I would have been with the company now for the past 12 years. That one single interaction where I met Dr. DeLito and Don Payton, the then CEO at the time, at that day, that interaction led to so many other things. It would have an impact on how I invested. It would have an impact on my career. It would have an impact on the business mindset that I would have, etc. So I would like to know from you, what was yours, and what was the trigger? The trigger, by the way, was the action that I took in order to upskill both myself and my husband at the time. It was a random meeting because I intended to go learn an awful lot that day, come away and implement it in my options portfolio. I didn't expect the other things that happened. So in your case, what would they be? What would they be? What have been some of the biggest triggers? Maybe it was a big loss. Maybe it was a really big gain that you made. Maybe it was, as we've heard here from Dave, is that the Ultimate Retirement Solutions course by Jim Penna, maybe that was a really big difference. Maybe it was a book that you read. Maybe it was changing to a low-cost broker. Maybe it was the fact that broking you could now do in an app. Just tell me, what have been some of the biggest changes that have happened along the way that have triggered really big differences? And that is the point that he brings up in this, is tails you win. You don't have to get 50-50. If I was to meet the equivalent of a VectorVest every week, if I was to meet the equivalent of a VectorVest every 3 months, could I handle it? Could I actually have handled it? Probably not. And that's the point, that we look out for these really big things, but actually we only need a small number of them dotted. Imagine if a February, March, April of 2009 happened every 6 months. Because of course, for February, March, April of 2009 to happen, you needed 2008 as well. Most of us will never see that again in our lifetime. And similarly, you could say the same of February, March, and April 2020. I remember that too. I remember getting back into the market, all of those, but I also remember getting out of the market on the 12th of March 2020 going, oh my God, this is unbelievable. So let me just see here, what have you got to say? Dave, by the way, I agree with you that Chris did learn a very valuable lesson in 2022. I agree with you wholeheartedly there. Let me see here. Chris said, I learned that I need to be excited about the process and let the result take care of itself. I'm going to talk to you about that in a different book as well, Chris. Terry said, buying a psycho stock years ago, able to put my kids through college from this one purchase. There we go. There we go. Is that if you can do that with one stock, imagine how many of those you need in order to actually make really big differences. Like, how often do you need to put your kids through college? Mal said, finding VectorVest. Francisco said, I started in 2008. I learned by trial and error, but I made good improvements. Still learning. G says, I live in Belgium. I was in NVIDIA HQ at San Jose, Silicon Valley 1 week ago. That would be really interesting. Errol says, Enron and the Brothers, silver scams. Okay, there you go. And of course, this, this generation's version of that might be Bernie Madoff. I was going to look at that actually on Netflix on my way over, but I was rereading this instead. Iraj says, when I first bought my first house, started investing in the stock market. John said, I would say, after being with VectorVest for a couple of years at the time, when the market was falling 2001 through 2003 and being able to short those stocks that fell, then going long in March 2003. Really good direction there. Or else has made my dive into my companies more. Okay, excellent. Now, by the way, another thing I would say is when I started listening to earnings calls, I got so much more depth into the business behind the stock. Now I have a really good understanding of the stock market and how VectorVest analyzes, and really that's all an investor needs. But as a business person and as somebody that really likes getting in behind it, when I started listening to earnings calls, that also, I would say, was a really big change, that it gave me more, like you would say, a deep dive. Amir said 2019 till 2020, I never thought the market was going to go down again, like what happened. Yeah, but you know what, Amir? We always say this time it's different. Mick says, when airplane travel was reduced about 7 years ago, my Hertz stock went up 150% in one day. Oh, was that 2010? Was that the volcano in Iceland? Is that what you mean, or was it a different one? Amir said, totally wiped out in 2022 with VectorVest. January 2023, finally started making some money, but being too scared, I've not made much. Okay, yeah, and you'll work all of that out, Amir. Kirk, I'm going to come back to you on that point, but that is certainly a very good point that comes up here, is that you actually, and based on what we're seeing here, the theme is true, is that you actually don't need to have too much really, really good stuff to happen in order to make really good things happen. Now, the next thing as well that I want to point out is that it's another chapter title, and I'm going to summarize what it says in here. It says, wealth is what you don't see. And the point he makes here is that, let's say that I'm sitting here and I'm outside, I have parked my Porsche and I live in a like $2 million home, and I have got all of my clothes are all designer and etc. etc. Is that's not wealth that I have, because that money has been spent. In order for me to turn that money into something else, I would have to sell my home, sell my car, etc. And his point is that we often see outwardly wealth. We think we do, but actually wealth, things that you see, if you see me wearing it, driving it, living in it, that is money spent. That's his point, that wealth is what you don't see. Now, you could say, yep, that's more of a personal finance point, but actually what I will say, and I do want to make this point to you, is that also I would point out wealth is also in your unrealized returns. If you were to say to me, well, Susan, like a lot of you were saying there about what you made in NVIDIA, what you made in Hertz, what you made in Colgate. But actually, I have stocks that I haven't realized them yet, and therefore I can say how I'm doing in them. But two things. Number one is that if you haven't realized it, you don't own it. If I, like, for example, you'll see it in my views this week. I bought one of the top VST stocks in Europe a while ago. It's called Saint Microelectronics. It's trading in Paris, and I bought it a little while ago, and the stock is doing well, right? It's not going crazy, but it's doing well. Now, I don't own the return that I've made out of that, nor do I own the dividends that I am due to get from that until I get it, until I realize it. So the first thing that I would say is that, of course, your unrealized gains aren't gains until you realize them. But secondly, I can't tell you how well I'm doing in a certain stock until it's realized there as well. So it is important when he talks about wealth is what you don't see, the returns that I haven't made yet, of course, is going to come to me. But similarly, until I realize something, then I can't say that I've actually made it. And on this very point as well, I just want to pick up on one thing. Sorry, actually, no, I'm not. I'm going to pause that for one of the other books. Sorry, I was just about to tell you a story there, but I won't. Let me take a look over here. I was in Google and Amazon in January 2020, was doing really well with no plan. Then COVID happened. I joined VectorVest and I'm still learning. Absolutely, Maria. That's what it's all about. That is, of course, when I met you too, because I only started the show in June 2020 at the same time. Or also plus finding VectorVest when I retired. Delighted to hear that. Really delighted to hear that. By the way, Joey has just put a prompt in there. VB Nation, hit that like button for this great content. We would love if you would do that. Will you please like this video if you're enjoying it today? I have another 4 books to go through. This one is going to take the longest, by the way. I have another 4 books to go through. But please do like this content. We would love that. And if you are not a member of this channel, make sure to subscribe to the channel so you know every time any one of us goes live. Whether it's me or whether it's Glenn or whether it's any one of the team, please do hit the, so we would love you like this video, subscribe to the channel as well. Okay, now, 2 last things I'm going to make here, right? One of them is he talks about room for error. This one is down here, chapter 13, okay, room for error. His point here is that you need to leave room to be wrong. Now, are we willing to talk to each other here today about times that we have made bad decisions or bad outcomes have happened, right? I have told anybody that has been on the show before, you will know the time that I was selling put option after put option after put option after put option back in, I think it was April. I don't know if it was 2011 or whether it was 2013, and I was selling them in silver just as it was going parabolic. Now, when the stock goes parabolic, this is what happens. Okay, really bad, really bad decision, and I was selling put options. It was a bad outcome and a bad decision, and I'll differentiate why I'm mentioning both of those in a little while. But the point he's making here is that you have to have room for things to go wrong. How many of you here are talking about that you're still learning? I'm still learning, and I'll be learning until the day I die. But if in order to learn, you also need to leave room for this to go wrong. And this is why this is where I wanted to pop across over here to my VectorVest screen, and I wanted to show you something over here. Okay, so if I was going to take one of the most simple strategies in VectorVest ever, it's one I talk an awful lot about. Again, if you've been here with me before, you've heard me talk about this. There's probably nobody in the VectorVest team that you haven't heard this from. So I'm going to go in over here to Stock Viewer, right? I'm going to head on over here to Stock Viewer, and basically at a basic level, what I'm going to get here is I'm going to get a list of the stocks in the database, and it's going to be ranked by VST. Now, if any of you do not know what VST is, I'm going to give you the 30-second description. And while I'm here, Joey, can I ask you to put a link into the chat here? And I am going to, could you put a link into the chat there to give people the ability to get their own free stock analysis? So if you want to get the VST on any stock, you can. Okay, thanks, Joey. Now, VST is a combination of value, safety, and timing. Put all of those 3 together, okay? Value, safety, and timing. And what value, safety, and timing is: long-term price appreciation potential, as well as consistency and predictability of financial performance, as well as direction, magnitude, and the dynamics of the stock. Put all of that together and you've got VST. You've got value, safety, and timing, right? That's the 30-second version. If you'd like to learn more, you can click on the link that Joey is going to be putting into the chat there now in a moment, where you can download your own free stock analysis and you can read more about it. And I've more to tell you about it anyway in a little while. But this is the default position of the US, of any of them, of any of the VectorVest databases. This is the default position. Let's just say at the beginning of the year, I'm going to go back to the beginning of the year, right? So I'm going to go back to the first trading day of the year, okay? First trading day of the year. And I go on here to the 3rd of January, okay? First trading day of the year. Now, I buy the top 10 stocks here, right? So you can see in some cases we have got leveraged ETFs. We have got, thank you, Joey. The link there is in the chat now for anybody that wants to get a free stock analysis of their stock. Just use that link, and an explanation of VST will be there, and the VST rating of the stock will be in there as well. Above one is favorable for VST, below one is unfavorable. The higher it is, the better. So you can see here I've got Super Microcomputers, I've Catalyst Pharma, I've Sterling Infrastructure. Okay, let's say I don't know any of them. Anyway, I simply buy the top 10 VST stocks in the US market. I buy them and I hold them, right? Now, let me just quick test that. Okay, top 10, here we go. All right, now, just in case that's not easy to see, that would have delivered me 33% return this year so far, okay? And in comparison, if I was to compare that to the S&P 500, I would be well outperforming the S&P 500. The S&P 500 has delivered 20.26% so far this year. That's not the ETF, that's the index. Now, you might say, okay, well, look, I could choose different dates. Of course I could. I know I could do all of that, right? But the point I'm making here is this. I've taken a really rudimentary return. I've absolutely well outperformed by I've done more than half of the S&P 500 again, right? And in here, how many stocks actually made money? The reality is 5 of them. Half of them made money in that period of time. The top one is the tails return that I was mentioning earlier. The top stock delivered 293.25% so far this year. Okay, so the reality is that most of this return is being driven by one stock. But if I'm not there, if I don't get that one stock, well then of course I would be dramatically missing out. But of those other 5 stocks, one of them lost 64.75% return. Now, what of course I could talk about here is making sure you've got your stop losses in here, and maybe your stop loss is at 20%, or maybe it's 10%, or maybe it's the VectorVest stop loss, whatever it is. The point is, I could probably have even done better here if I was to use market timing. I could have done better in here if I had stop losses in stocks and all of those things. But the only single point I want to make is that in order to get this return, I did not have to get all my stocks right, or not all of them had to deliver a return. In fact, half of them didn't. In fact, one of them lost 64%. One of them made 36%. One of them made 73%. One of them made 62%. This is what the stock market is all about, is that it is full of uncertainty. But you have to be able to leave room for error. And this is one of the points he makes here, is that if, let's say, I left the house where I'm staying in this morning, it takes 16 minutes to get to the office. If I leave 16 minutes before I get to the office, let's just say it was 16 minutes up until 11 a.m. Eastern time. There is no room for error here. There's no room for traffic jam. There's no room for anything to go wrong. And instead, of course, we left a lot earlier than that. I was in the office a lot earlier than that. I was in the office and Joey and I do a tech check beforehand. They're all room for error. If anything goes wrong, well, then we can handle it. The same needs to apply over here. So there has to be room for error in the stock market. Now, my last point, right? Very last point in this before I move on to my next book is this one. It's it's just the last chapter in this page. There's a couple of other chapters in the next one, right? It is the seduction of pessimism. The seduction of pessimism is, I don't know how you're going to feel about this, right? So I'm going to ask you about this instead. How often do you look at your trading account? How often, right? This is because this is going to feed into the answer over here. How often? While you're answering me this, I'm just going to take a look over here too. Remember that time the market didn't come back? Not lol, it's never happened. Good point, Kirk. Okay, I see people are talking about Dogecoin. Yeah, it's a cryptocurrency. Today we're focusing on the top 5 investing reads from the stock market point of view. Dave says the market eventually comes back, but holding through a large drawdown is painful. Agreed, Dave. And that's the thing about the power of compounding and about looking back and about a book that I'm also going to come back to. It's my 5th one that I want to mention today. Let me see what else. Twitter will turn into a crypto exchange powered by Doge. Anyone seeing this? Okay, interesting point. Kirk says, isn't that the same with stocks? It's not wealth until you cash it out. Yes, it is. Well, I mean, the thing I would say about wealth and being held in stocks is that the possibility is there for them to rise, but you can never say you have the money until you cash out. Kirk says you got to hold when blood is running in the streets and use market timing accordingly as well. Let me see here. Julie says, Susan, hello from London. Hello, Julie. You're very welcome to be here. So, Has says weekly. Mal says every 3 or 4 days. Roger says twice daily. Sharon says, every day in the Jockey Club. Okay. So, what he's talking about here with the seduction of pessimism is that if we look at our accounts every single day, right? Let's say we look at it like a lot more often than that, is we can feel the downside more than the upside. Right? So if I see that my stock is down 1%, I feel worse than the happiness that I feel if my stock is up by 1%. And that's his point. But if I wasn't to look at this every day, if instead I was to look at this maybe like Mal does every 3 or 4 days, how then let's say I'm feeling the same, right? So for every down and up that I'm feeling, the down that I'm feeling is more, there's more impact in the down versus the up. But let's say that I only look at this, let's say once a month. Well, then the reality is that whatever volatility that has happened has probably earned itself out. If I look at this only once a year, well then probably on average, if we look at the number of years the stock market is up on an annual basis, there are more than downside. And then if I never look at it at all, like, you know, Warren Buffett says you should be only buying stocks where you can leave the stock market for 40 years. I don't necessarily agree with him primarily on that now, but the point here is that he's making is that if we respond irrationally, psychologically to our returns, if we give more attention in our hearts than in our heads to the downside, is actually we can have a very different perception of what actually happens. So instead, if we were to look at this from the point of view of understanding, like you're talking about there in a downturn, like if we're saying, okay, the stock market's never going to come back, or if we're just looking at down days every single day or over a period of time, we can actually take in more of the downsides that happen. And that can be something that can be very tough to take along the way. So his point is that, number one, if you're going to look at your trading accounts often, which a lot of us do, by the way, which I do, well, then we need to be understanding that psychologically we can be more affected by the downs and the ups. Like, look here, look at what I'm showing you here on my screen. This is the 33.44% return. If I just looked at the market, if I only looked at my trading account on the 27th of July from 3rd of January, I would say, woohoo, happy days. There's nothing to see here. This included all of what happened with the banks in March. This included all the volatility that's happened around interest rates, all of that. But all of that has been both processed in and processed through over that period of time. So he talks about that we have to be aware of the tricks that our mind can play on us when we see ups and downs. Kirk says, is VectorVest strategy buy, sell, day trading, puts, cover calls, etc., as opposed to buy and hold strategy? So Kirk, VectorVest is a system that is designed to take care of, exactly as Brandon said, your strategy. It can be any of those. If you're somebody that is day trading, we have a jockey club and we have lots of indicators to take care of that. In my case, I'm somebody who sells puts. I'm somebody that sells cover calls. I'm somebody that uses options, and Ron, who's based here, he talks a lot about options. I'm also somebody that buys and holds for a significant period of time. We also, of course, have people like David Paul, who talks a lot about day trading. So VectorVest is designed to take care of you, whoever you might be. There isn't a one specific ideology that's involved in any specific one of that. Okay, so let me now move on to my second one. But before I do, I just want to mention this. These are just a couple of points that I've picked out at Psychology of Money. Really, really great book. Highly recommend it to you. I read it for the first time in February, and then I read it again, and as I say, on my way over. Really easy read, well worth it. Okay, next one. Now, the next one, of course, is going to be really obvious to you all, any of you that has been familiar with the VectorVest community, and that is this one. And this is the one written by the founder of VectorVest, Dr. DeLito. And this is Stocks, Strategies, and Common Sense. Now, for a start, I do want to make the point that any one of you can download this book for a start, right? Again, it's a well-written and very direct, practical, no-nonsense book. And Joey, can I ask you to pop the link there into the chat, please, for anybody who would like a copy of this, right? So this is Stock, Strategies, and Common Sense. You can see here, pretty short read. Now, I'm going to pick out the 3 chapters in here, and I'm going to do it quickly. The 3 chapters in here that really stand out to me. And these are the 3 favorite indicators that I have in the VectorVest system. Right. First and foremost is one that a lot of people, that I've already referred to anyway, but a lot of people read a lot about, is VST, Value, Safety, and Timing. Now, let me just take you through the contents in here, right? So, as you can see here, chapters are quite brief, and the point is made very, very quickly. But what each chapter does is it takes you through each of the proprietary indicators in VectorVest. Somebody asked me yesterday, how would I distinguish VectorVest from any other provider, stock analysis provider in the world? Number one, I would always say the proprietary indicators. The way in which VectorVest analyzes stocks is different to anywhere else. They are proprietary indicators, and one of the top ones is VST, Value, Safety, and Timing. The second thing is, of course, is that the track record of VectorVest is that it has been around more than 30 years, and there's very few providers that do that. I just want to give you the third one. that underpins what I'm saying, and that is that all of the work that's done in the VectorVest program is algorithmic, and that means that the system updates. In the US it's real time, in Canada it's real time, but in my market in Europe it's not, it's end of day. But it doesn't depend on anybody. It's not dependent on me going into the market in Europe, taking a look around at everything and analysing it myself. It's not dependent on me. Instead, it is dependent on an algorithm, and the algorithms, broadly speaking, are explained in here. So that's just 3 ways in which VectorVest is different to anything else. It's not dependent on a person, it's algorithmic, and it has a really, really, really long track record. Okay, now Kirk says as much as necessary, as little as possible. Yeah, that's a good, that's a good point. Okay, so the 3 indicators that I really like and that are explained in this book, I am going to bring you across. So VST I've already explained. Okay, VST I've already explained. VST is value, safety, and timing. Now, the next one, I always talk about this indicator, but I don't think there's as many. I don't think this indicator gets as much love as it deserves, and that is the comfort index. Now, I am going to right-click on any of these stocks. Bear in mind, in the chat here already, I have asked Joey, and Joey kindly did put in a link here to the free stock analysis. So any of you can get what I'm about to get by simply clicking on that link, putting in the ticket code of the stock that you want to analyze, and then you'll have what I have, right? But I'm just going to go into NVIDIA. That's one of you mentioned that. Okay, so here's NVIDIA, right? So here we go. NVIDIA so far today is down 2.05%. I can see the price at the moment is $143.15, etc. But what I really want to know right now is I would like to know the comfort index in NVIDIA. And you might say, what is the comfort index? Let me show you. Brandon is a fan as well. Yeah. Not surprised. I just don't know why more people don't look at this. But anyway, let me just scroll on down here to CI, comfort index. Okay. CI is an indicator which reflects a stock's ability to resist severe and or lengthy price declines. Okay, so it's an indicator which reflects a stock's ability to resist severe and or lengthy price declines. Now, lots of us would really like stocks that can do that if you are somebody that is around for a long time. So Dave says you call it the consistency index. As a retiree, you love consistency in your stocks. Okay, now what I always do here, Brandon and Dave, at this point is, it sounds great. An ability to resist severe and or lengthy price decline sounds great, but like, what does it mean? And rather than explain it in words, I always explain CI in pictures. So let me just do that for you. I'm going to take out NVIDIA here, and instead, by the way, to anybody who's unfamiliar with, again, the VectorVest proprietary indicators, above 1 is favorable, below 1 is unfavorable. And so when we have a CI of well below 1, well then, like NVIDIA does, that says that the stock doesn't have an ability to resist severe and or lengthy price declines. But let me show you what, and that's not to say, like, there's a lot more analysis goes into a stock like NVIDIA, but I'm just looking at the CI for the moment. So let me show you what happens when I rank the entire database by CI. Okay, so here we go. Now, as you can see, I've got one of these stocks here as a sell recommendation, right? I'm aware of that. This isn't about buy, sell, or hold recommendations. This is about ability to resist severe and or lengthy price declines. Now I'm going to show you what CI is in a picture. I'm going to graph all of these selected and look at what this is all about. Okay. Now, that stock does not look like a high CI stock. Let me just go back and check this. Let me just go back and check this now. Now I know. I need to go back. I was wondering that something looked wrong. Of course, I hadn't updated my dates. Let me now go to today. Now let me explain this to you. Okay. Have we got, is everything there now listed by high CI? Yeah, okay. Here we go, and this time I am going to graph selected. Now you'll see what I'm going to show you. You see, because I know what's going to happen, because this is what CI does. So high CI stocks start at the bottom left and move to the top right. So you'll see. Okay, so there's the first one. That's the highest CI stock in the database. Let me go to the next one. Let me go again. Okay, I'm going to graph all. Right, here we go. Top, bottom left to top right. Next one, next one, next one. next one, 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 next one. There you go. There you go. That is what your high CI stocks look like. They start at the bottom left, they move to the top. Now, of course, you might say, yeah, but that's what happened in the past, what happens in the future, and this is why you need VST as well. But I think Comfort Index does not get the love that it deserves, and it deserves a lot more than that. The third one is something actually that Dave has already referred to, and that is RS. RS is also, this is also another book. Sorry, it's another chapter that's in here. It's relative safety. Relative safety is a stock's consistency and predictability of financial performance. Okay, so let me go right over here. So this time I'm going to rank. I love saying this statement, right? I'm now ranked the system in terms of safety. I have now pulled up the top 10 safest stocks in the database. What does safe mean in the context of the stock market? Consistency and predictability of financial performance. So this is actually the one that I told you I had bought. Now I bought this in Europe. I bought this in Europe and I bought it in Paris. As you can see, having a lovely day today. But yeah, Same Microelectronics is a stock that is European and it's in the top 5 VST stocks in Europe as well. So this, as you can see here, RS is consistency and predictability of financial performance. And I remember it was Glenn that taught me about this my first week that I was actually in the office in North Carolina. And what this refers to is the ability of the stock to make money quarter over quarter, year over year. And what it means by consistency and predictability is the dividend set to grow? And how is the dividend set to grow? Are the earnings set to grow? And are they doing so with consistency quarter over quarter, year over year? So as you can see here, now one of the things that I invite you to check out that I don't have time to check out with you today is the birthday game. The birthday game is it's a strategy, not a strategy. It is a reference point that we often talk about here at VectorVest to talk about the power of relative safety. So if I could just go back there to Kirk when he said, you know, is VectorVest around buy and hold, etc. So relative safety would be more for that prudent investor, and it focuses on the consistency and the predictability of financial performance. RS is not going to be necessarily of interest, for example, to your day trader, but it would be instead to your potentially your retiree, to that person who looks for capital growth, to that person who looks for capital growth and dividends and total return, etc. Okay, so I invite all of you to read that. As you can see, it's a simple read. It's written in his voice, like you really feel like you're talking to the man. Now, I have been fortunate to have had several conversations with Dr. Toledo over the years, so I can tell you his voice is right in here. Joey, what do you think? Does this sound like the man himself? You've met him many more times probably than I have. Okay, moving on to our next book then. Okay, I'm just going to and I'm going to be much. I just want to pick out one point in each of these. Let me see here. Kirk says, "What's the book on the desk behind you?" That's actually my own one. It's not. Now there's another one that I'm going to be talking about today, but that book is called The Savvy Woman's Guide to Financial Freedom. It's a book that I wrote for women about general financial wellness. I suppose that's more a term today, but particularly it's all around particularly mindset and focusing on how you can manage your money better. But also understanding that a lot of the financial decisions that we make are driven by mindset, and also a lot of people aren't aware just of how many people are willing to help you to manage your finances. So I point out a range of resources that are out there to help you to be better with it. And also financial freedom is far less elusive than people think. Now, this is my third one. This is my third one here. So you can see here, The Little Book of Big Dividends. And this is by Charles B. Carlson, who actually has the same professional qualification as me, which is a CFA, Chartered Financial Analyst. Okay, now, the main point, I'm going to pick out the 3 main points here, and then I want to briefly talk to you about how you can find this in the system. The point here that he makes is, and it's a very, very simple, I just want to give you he has a summary at the end of each chapter, right? And the first one here is, dividends matter. Nearly half of the stock market's long-term total return comes from dividends. So the point is that dividends make a really, really, really big difference. Oh, sorry, that camera now isn't quite in focus there because I've brought it up too close. It can make a really, really, really big difference. So understanding how to navigate dividends is really important. Also, he makes the point that, I just want to go down here as well, so you can see my bookmark. He says the payout ratio is the single most powerful tool for assessing the health of the company's dividend. Ignore it at your own peril. In other words, dividends are important. And if dividends are important, well, then you need to know, number one, that they're significant, number two, that they are going to stay. And then, of course, another point that he makes, and this is the third one here, and this is only at the start. The book really does delve into what I'm about to show you now, but buy stocks that score well on dividend criteria and investment criteria. So, of course, you want a dividend that is in existence, and also you want a dividend whereby you want it to be sustainable and you want it to grow. But it shouldn't just be about the dividend. You also want to make sure the company is as well. Okay, now, how do I take the points, the main points that are made in this book, and translate them into VectorVest? Okay, what I'm going to do is pop across there onto my screen, and I'm going to show you how to do that. Another indicator that we have over here is called YSG. Let me scroll over here to the right. Right. Here we go. YSG. So YSG is an indicator that VectorVest came up with, and it's referring to yield, dividend yield, safety, and growth. So it's combining all of what is said in that book. So how can I find dividends that have got significant yield, that have got significant safety, and have got significant growth? Yield, of course, is the dividend divided by the share price, just like I showed you earlier on with Colgate. You take the amount that is going to be given by the company to shareholders, and you divide that by the share price. There you've got your dividend yield. Okay. You've also got dividend safety. So dividend safety is how likely is the company to maintain its dividend. Now, let me tell you where dividend safety comes from. It comes from the same place that was referred to in this book, which is payout ratio. Is the company making enough money to pay out its dividend? Now, last June, I think it was it June? Maybe it was May. But I was a guest at the VectorVest International Forum, and Stan was speaking at that. Stan Heller, many of you will know him. David Paul was speaking at that, and Jerry was speaking at that. Jerry D'Ambrosio. Again, a lot of you who are here on the VectorVest channel, you know all of those. If you don't, by the way, please do subscribe to the channel, and then you will get and press the little bell button so that you know when any of us are going live. Anyway, on that day, I was talking about, I can of course, sorry, just before that, I'm just going to respond here. What does YSG stand for? YSG stands for yield, dividend yield, S is dividend safety, and G is dividend growth. And again, if you right click and you view a full stock analysis report, you will get the explanation of that right down here, YSG. There you go. And the explanations of all the others. The other point as well is that in the green book, you get explanations of them too. So lots there to work on you. So during that VectorVest International Forum, I was analysing earnings, and I was particularly analysing the earnings call from the latest Apple earnings call with Tim Cook. And I had pointed out something that I felt a lot of people missed was the fact that they really referred to how much they were committed to maintaining the dividend. Walgreens, the same. Really, they were really focused on saying that we're committed to the dividend, but you have to commit to a dividend with earnings, not just with words. But that is also another point, is how much emphasis does a company put on making sure that they take care of their earnings, because in their earnings, they need it to be sustainable and they need to have a significant payout ratio. And they also need to make sure that there's lots of money then to reinvest back into the company to build and grow and invest again. So the point I wanted to make is right here in this book, the little book of big dividends. It's all about basically what you see here on VectorVest and YSG, having strong, solid dividends that are sustainable, that are growing. And there's a number of other elements in there as well, but I will loop back to the first point made in here. That is that half of the stock market returns, as evidenced in this book. Now, if I was to go back and look at the last decade or the decade before that in an era of low interest rates, we might challenge that. But the main point is that a very significant amount of stock market returns, if reinvested and thus compounded, come back to the psychology of money, then you can have a very significant return from dividends, but you need to know how to handle them as well as possible. And as I say, YSG is a great place to do that. So what I would do, for example, is check out the stock that you have. I'm going to take Colgate here and check out what its YSG indicator is. Above one is favorable, below one is unfavorable. Let's scroll over here to the right. And we can see here the YSG is at 0.91 at the moment. Below one is unfavorable. So instead, I could also just check what are the stocks with the best YSG indicator. And of course, I also know that what I want to do is I want to make sure that the stock has got Advocate Rising. There we go, 1.73. And that's a dividend yield of 25%. Whoo! I need to get in and look at that now. But oh yeah, that's a fixed income and treasury. That's an ETF. Okay. So, and I would need to get in and I would need to get a lot more. I want a lot more analysis in there to make sure that I'm combining capital growth with dividend safety and yield and respective growth as well. But YSG is a place to certainly check that out. Okay, moving on to my book number 4. Now, this is just going to be a brief mention that I'm going to make, and this is a book that I wrote, right? So I wrote this with 2 teachers, and it's called Positive Economics. The reason that I'm bringing this one is that I could have picked a million economics books, and the point I wanted to make is economics and the stock market are really, really interwoven. And it's well worth your while understanding how the economy works, whatever way you do it, whether you get a short course on economics on YouTube, or whether you decide to do, whether you listen to podcasts about the economy. It's probably something I'm going to be doing a little bit more with you here on the VectorVest YouTube channel. But I certainly do recommend that you understand the economy and put time into understanding how it works. Because look, let's just look here, front page of VectorVest. Sorry, front page of the FT today. Look at this. Global stocks rally as ECB joins Fed in lifting rates. So over the past 24 hours, we've seen the ECB and the Fed lift interest rates. And look, immediately that has an impact on the stock market. And when we look at markets, if I just scroll down here, really, like I can just pop down here, right? Investors shun US consumer stocks over recession fears. So there's worry about the economy. Of course, that affects the stock market. Down here, and by the way, a term that I want to point out to you is immaculate disinflation. Immaculate disinflation. Oh, sounds great, doesn't it? Immaculate disinflation is a term that I'm coming across more and more now. Immaculate disinflation. This is something that Reuters are talking about. The FT is talking about. I'm coming across this more and more over the past week. Immaculate disinflation is if you can take inflation out of the economy, right? So decrease inflation. That's different to deflation now. Disinflation is when you're slowing inflation down, but prices are still rising. Immaculate disinflation is if you can do that while maintaining the labor market and maintaining the growth in the economy. That is what immaculate disinflation is. So if you understand what's going on in the economy, that can really help you to understand how things that are happening in the news, in the economy, in conversations that are happening in those earnings calls, that can have a really, really, really great help when you are coming to understand what's going on in the stock market as well. Okay, so pick any economics book you want, but understanding and having a sense of understanding can be really, really helpful. Kirk says, I've heard that if dividends go to a high of say 7%, that can be a sign of trouble in the company. It can, Kirk, and that's the thing, is that's why you need to look at the dividend safety as well. And of course, you also want to see if the dividend is growing. So that's why YSG wraps all that up. But if you combine that with something like VST and your CI, so your value, safety and timing and your comfort index, and package all those together, there's a lot of analysis that can be done within that. And all you need to do is create that in a single search on VectorVest, and that can really advance your stock selection very, very well. Now, I have 1 minute to go. And in that, I'm going to mention one more book. I haven't finished this. And the reason is that I wanted to read this, and then I realized, okay, I can't read it when I'm here. So I've started listening to this. Now this book, okay, I want to point out to you is, I tweeted in June that I had bought this book, Atomic Habits. That's one I'll tell you about another time. And David Paul, okay, again, a lot of you will know him. He is managing director of VectorVest UK. He tweeted me to say one of the best books on my shelf. I refer to it often. In terms of trading success, it's up there with Douglas in Trading in the Zone and Anne Duke in Thinking in Bets. Enjoy. So I have started listening to the audiobook. And I tweeted this morning, okay, I tweeted him this morning and I just said, I'm listening to Thinking in Bets by Annie Duke, based on your recommendation, David Paul. If it's on your bookshelf, it's definitely worth the read. The analogy of the medical sales is thought-provoking. I'm featuring it in today's Savvy Investors episode. So, in an ode to the man himself, I want to tell you why I think, apart from the fact that he's talking about it, and if David Paul is talking about a book, it's definitely well worth reading. But Trading in Bets talks about how life is a game of poker and not a game of chess. And specifically, the reason is that when we are playing chess, I don't play chess, by the way, but I did look at the Queen's Gambit on Netflix, so that's the only insight I've had into it, is that you can always, full information is always available to you, right? You can always see all the pieces on the chessboard, and one person can outsmart the other. The reason that life is like a game of poker is that I can't see the cards in another person's hand. So what the book is about is that I have to be able to deal with an awful lot of uncertainty when I'm dealing in the stock market. If today I was to invest in Apple shares, there is so much that I don't know. Yes, I can look at its dividend. Yes, I can listen to the earnings call. Yes, I can analyze it on stock. I can get a stock analysis on VectorVest. Yes, I can look at its RS. Yes, I can look at its CI. Do I know what's going on in the boardroom right now with Tim Cook and his staff? No. Do I know the impact of a piece of regulation that's happening at the moment in China? No. Do I know what the real plan is for the Fed? Now, I know what the analysis of the market is saying about the Fed when it meets again in a couple of months' time. Do I know the impact that that will have? No. And that's her point, is that we have to think about life as a game of poker. The last book, yes, of course, can. I'm just going to pop on over here. I have the tweet there. If anyone, that's where it's called Thinking in Bets by Annie Duke, and it's based on a recommendation by David Paul. So that's the name of the book. But to finish on it, she talks a lot in the opening chapter. So I haven't finished it, but as I say, I wanted to refer to it because David Paul recommended it. So I wanted to talk about it today. But particularly, she talks about the difference between a good decision and a good outcome. So she poses this question in it. If you think about the best decision you made in the past year, and then you think about the worst decision in the past year, are you actually thinking about the best outcome that happened, the worst outcome that happened? Do you confuse decisions that you make with outcomes that you have? Because what if I buy Saint Microelectronics? All right, you saw the reason I bought it. It's top 10 VST stock in Europe. It's top VST, top RS stock in the US. You could say that my decision making there is sound. But what happens if that stock goes wrong? And then do I say, well, I made a bad decision? Well, no, I'm happy with my decision. Sitting here talking to you right now, live at 12 noon Eastern time, I'm happy with that decision. But the outcome of that, I can't control. I can put in a stop loss and I can cut my losses, of course, if it goes down. I can sell, and of course, if I sell, well, then I'm going to realize again, all going well, out of it, and then there's another decision about when that would be. But the point is, I am dealing with asymmetric information. The only information that I have on that stock is in the VectorVest system. That's the reason I bought it, and I stand by it. But no matter what happens to the outcome, is that I'm dealing with an awful lot of asymmetric information. There's a lot of information that I don't have. So it's important as an investor, number one, to understand that. Number two is to not also, and a number of you talked about it there, is some of us think we're brilliant investors because we're investing at a time when loads of stocks are going up. That doesn't mean our decision making is sound. It means that we're actually in an environment where it's easy to make money, and we can't say that all the time. But if a lot of stocks are rising a lot of the time, well, then it's a lot easier to make money than when they're not. And the point she's making is we need to distinguish between our decisions and our outcomes. Secondly, to be aware that there's a lot of information we don't have, and therefore to attribute a characteristic to ourselves, like I'm a good investor because of my returns, it actually is incomplete. I might be a good investor because of the decisions that I make, because of the understanding that I have of the asymmetric information and my ability to handle that. So I am really grateful to thank and want to thank you all for joining me here for this episode. So to quickly run through the 5 books that I had, is that number 1, I have Psychology of Money. Number 2, this one, Stock Strategies and Common Sense by Bartolito. I also need to mention the author, Morgan Housel, is The Psychology of Money. You can download this for free from us today. Now, this one is The Little Book of Big Dividends by Charles B. Carlson, who is a CFA. The next one is this one, an economics book, but I just wanted to point out this. So this is a textbook that I wrote with two teachers from Ireland called Positive Economics. Some of you may know I'm known as the Positive Economist. And this is by myself, Susan HayesCulleton, Trudy Murray and Brian O'Connor. And then the other one that I mentioned is Thinking in Bets by Annie Duke. I don't have it to hold up because how I am reading this book right in here. And so I also want to give a shout out to David Paul and to thank him very much for his recommendation. So, ladies and indeed gentlemen, thank you so much indeed for being here with me for this episode of Savvy Investors. I put a lot of work into today's episode because I wanted to make sure that you had 5 solid reads and reasons for those reads. So I hope that that has certainly been helpful for you. Edward, Atomic Habits, brilliant book. I'll be talking about that as well in future episodes. So delighted. Thank you all very much. And not just for being here, but for interacting with me as well. It's always one of the things I love about this audience more and more. So, as I say, from me here, Susan HayesCulleton, live in Ohio, thank you so much for joining me and every best wish to you all. Thank you to Joey for producing today. Thank you to David Paul for the recommendation. Thank you for the authors for writing the books. And most of all, thank you, our audience, for being here with us. Bye.